let's say, for example, you find a resistance zone that you think price might bounce at. And on the higher time frames like daily and weekly, price has bounced here a couple times. So as price comes up here towards this zone, you think that if price gets there, it might bounce downwards. And how would you profit from something like this? Well, it'd be very simple. You would sell at the resistance zone, stop loss would go somewhere above the zone, and the target would go somewhere below the zone. So with this being said, what happens to your risk structure if you enter right here, right? Now your risk reward goes from a positive risk reward to like a negative. Now you have to have all the way down here just to be a 1-to-1 risk reward. Well, what happens if you wait for price to get here into the zone, right? To where it just gets into the zone. Well, now your risk structure looks something like this. You have an entry there, you have a stop loss above the zone, and you have a target somewhere below. So you can at least get a 1-to-1 risk reward ratio. This is good. This is better. What happens if you enter and then price goes up here a little bit further into the zone, right? It's going into drawdown, but it hasn't broken the previous highs or any wicks past the zone. And so you wouldn't want to get stopped out of that trade. And it could really even go a little bit further and still technically be valid before falling and turning over. What happens if you wait for an even better entry? What does that mean? It just means that your entry is as close to the moment where price is either going to break the zone or bounce at it, to where your stop loss is the closest it can possibly be, and then the potential for profit is at least a 1-to-1 risk reward ratio.